A DSCR loan sounds almost too good to be true. Buy a rental property without using tax return the traditional way. But the real story is not no income. The real story is the property has to carry itself. DSCR means debt service coverage ratio. The simple formula is monthly qualifying rent divided by monthly housing payment, usually BITIA. If the property rent for $4,200 and the BITIA is $3,600, the DSCR is 1.17. That means the property produced about 17% more rent than the monthly debt service in this example. If the rent is $3,200 and the PITIA is $3,600, the DSCR is 0.89. The property does not cover for its own payment. On many conventional investment loans, the borrower still has to qualify personally through the TI, income documentation asset, and credit. On the DSCR loan, the lender is focused more on the investment property's income potential. That is why self-employed investors like DSCR. The tax return may be complicated, but the property rent can be more straightforward. This does not mean the underwriting disappears. Credit, down payment, reserve, entity vesting, appraisal, lease run schedule, and property type can all matter. The trade-off is that DSCR loans often cost more than agency financing. Rate, points, down payment, reserve, and prepayment penalty can be less favorable than a clean conventional investment loan. So DSCR is not automatically better. It is better when the investor's personal income does not qualify. The property cash flow is strong and the investor understands the pricing and asset strategy. A good DSCR video should always explain both sides. Easier income documentation, but potentially higher costs and stricter investor terms. DSCR is not a loophole, it is a different underwriting lens. Instead of asking how much W-2 income does a borrower have, the lender asks, does the rental property support the debt? For any rental property, run the DSCR well before you fall in love with the deal.